I think that's exactly right. And I think it's really looking very carefully at the fundamentals, which is something we've moved away from in the market. And I think we have to come back to it, particularly in this inflationary environment, Courtney. When I look at some of the names that were flashed up at the beginning, Warby Parker was one of them. Allbirds was another. I think looking very carefully at repeat rates, Warby Parker's got fantastic customer retention, very high repeat purchases on that site, versus something like an Allbirds, and look at those two, which are both at the moment fairly single product offerings, and compare them with some of the successes in the past, but also some of the failures. Casper, for example, was a disastrous IPO, and it's been a disastrous public stock since it went public. So I think comparing against real data points out there is going to be critical as investors think about which are real stories for the long run and what is really a product of just very inflated valuations we're seeing in the public market right now for some of these names.
And obviously, the idea of SPACs was really hot earlier this year. Direct listings sort of started picking up some steam as they moved away from more traditional IPO listings to go public. What should we pay attention to when it comes to the structure of some of these deals coming to marketplace?
When it comes to the direct listing, I think there are certain watch outs that the retail investor needs to think about. There isn't necessarily the same level of underwriting that has taken place when you've got banks who are out there managing the listing process. There's a lot more scrutiny when it comes to governance. If you take a look at Warby Parker, for example, there's still an enormous concentration of voting power and control that sits with the founders. And so the nature of these is important when we think about what level of diligence has been done on behalf of the retail investor. That's been a real question for the SPACs as well, Courtney. But there's one other piece I would look out to, and I think not enough attention has been paid to this, which is what are the valuations that these businesses have raised money at in the private market from investors who've been following them with a lot of information for a very long time, and then how much of a premium are these companies asking for when they go public, and can those big end premiums really be justified based on the time that's elapsed between their last private raise and the time they're IPO'd?
Absolutely. And we've been talking about a lot of these consumer names like Warby Parker, like Allbirds. But what about a company like Stripe? I mean, it's looking to go public potentially in this very hot fintech space. So valuation is probably something we should pay close attention to in one of these tech names, right?
I think that's exactly right. I think Stripe is a prime candidate. That is one where there have been rumors of anywhere between $95 billion, which I think has been a valuation in the secondary market relatively recently. Another one is Sweetgreen, which last raised capital at just under $2 billion, hearing whispers of testing the water conversations later this month at a $3 billion valuation. Another one, Courtney, is Rivian. Rivian raised capital at under a $30 billion valuation earlier this year. Rumors are now it's going to look to go public at $80 billion just 7 months later. And it's those kinds of disconnects I'm looking at to see if the public market can justify what the private market didn't actually buy into relatively recently as a valuation benchmark.